Let us see the theory of the mutual fund. Learning outcomes. After going through the chapter, the student should be able to understand basics of the mutual fund, evaluation of the mutual fund, classification of the mutual fund, types of the scheme, advantages of the mutual fund, drawbacks of the mutual fund, terms associated with the mutual fund. Mutual fund is a trust that pulls together the resources of the investor to make foray into investments in the capital market, thereby making the investors to be part of the owner of the asset of the mutual fund. So the mutual fund is on one hand say taking funds from the investor and making investment in the different securities. The fund is managed by professional money manager who invest the money collected from different investors in various stocks. That is, stock stands for say different securities, bond, we can say debentures, or other securities according to the specific investment objective as established by the fund. So it may be a fund which is going to take a risk. So investment will be made in the equity instrument, not taking risk. Then in that case you are making investment in debt funds. In risk also, that is in equity instrument also, more risk than small cap, less risk than large cap. You may be having diversified, or you may be having say the plans in which say there is investment in debt and equity both, that is balanced funds. If the value of the mutual fund investment goes up, return on them increases and vice versa. That is a simple rule. Net income earned on the funds along with the capital appreciation of the investment is shared among the unit holders in the proportion to the units owned by them. Mutual fund is therefore an indirect vehicle for investors investing in the capital market. So basically you are investing in the capital market only. I don't know that say, however, you might have heard that say sometimes maybe a person is having a doubt that say, I am not investing in stock market, I am investing in mutual fund. But you are making investment in the stock market indirectly. It is not that say you are not investing in the stock market. It is you are investing in the stock market if it is an equity oriented scheme. In return for administrating the fund and managing its investment portfolio, the fund manager charges fees based on value of the fund's asset. That is say 0.1%, that is what we have seen. So here basically we understand that say pull their money from the investors and so the return is say passed back to the investor. How does mutual fund work? Investing in the mutual fund is an expert's job in the present market scenario. A systematic investment in this instrument is bound to give a rich dividend in long term. This is why over 2 crore investors have faith in the mutual fund. What is mutual fund? Mutual fund is a trust. Importantly friends, it is formed in form of a trust that pulls means it takes savings of number of investors who share a common financial goal. A mutual fund is the most suitable investment for the cautious investor as it offers an opportunity to invest in diversified professionally managed basket of the securities at relatively low cost. Relatively low cost, it means that say basically if at all an individual investor is hiring an expert say to manage the portfolio, it will be expensive, and in comparison to that when you make investment through mutual fund, then in that case the same cost will be shared that is among number of investors. So we can say that so the mutual fund are trust which pull resources from large number of the investors through the issue of the units. So basically over here the units are issued to the investor for investment in the capital market instrument such as shares, debentures, bond, money market instrument, such as commercial paper, certificate of deposit scheme, and treasury bond. So the capital market stands for, in simple language we can say, stock market and other money market instruments, in which the commercial paper, you might have heard that say the high net worth, so the companies issue the commercial paper which is in form of a promissory note, and it is basically say for a time period which is less than a year. There is a specific time period for which the commercial paper can be issued, 3 months to 6 months. As far as the certificate of deposit scheme is concerned, it is simple. We understand that it's a fixed deposit, and a treasury bond, so which is issued by the central government. Who can make investment in mutual fund? Anybody with an investable surplus of as little as few thousands of rupees can invest in the mutual fund of buying units of a particular mutual fund scheme that has a defined investment objective and strategy. So basically there is a defined investment objective, that is the equity, debt, balance, that is money market instruments and so on. How mutual fund works for you? Friends, at your intermediate level you might have learned something like called Miller-Orr model, Baumholz model. In that, say they have a specification like this, that say you have to make investment of your surplus funds, say somewhere in a way that say something like this, Miller-Orr model, in which this is the lower limit, this is the return point, this is the upper limit. What happens that the cash balance will have a variation like this. So if at all the cash balance increases to the upper limit, then in that case you should make investment of, that is say, in liquid securities. So the mutual fund is practically the best example of the liquid securities, wherein you will get say relatively a fixed return with no like the restriction on the time period of holding. You can make investment even for practically for 1 day also you can make investment. How does it work for you? The money collected from the investors is invested by the fund manager in different type of securities. This could be range from the shares and debentures to money market instruments, depending upon the scheme stated objective. So one of the things that we have discussed earlier is that there is a good transparency when you make investment through mutual fund. So this is what it mentions over here, that you will be having set transparency of the objective of the mutual fund. The income earned through these investments and capital appreciation realized by the scheme is shared by the unit holders in the proportion of the units owned by them. Please refer to the diagram above, in a way that all investors will be given the return proportionately. Should we invest in stocks or mutual fund? So what may be the advantages or disadvantages when you make investments through mutual fund and when you make investment say in the direct equity? As soon as you have set your goals and decided to invest in equity, the question arises, should you invest in stocks or should you make investment through mutual fund? Well, you need to decide what kind of investor you are. First, consider if at all, if you have kind of disposable income to invest in 15 to 20 stocks. This is how many stocks you will have to invest, and if you want to create a well diversified portfolio. Remember that the familiar edge. Do not pull all your eggs in one basket. If rupees 5,000 were you have to spare, it would be impractical to invest across many stocks. So basically it speaks about the diversification. If at all you have less amount of the funds to be invested, then in that case making investment in 15 to 20 stocks is not possible. Even making investment in one stock would not be possible. It may happen like this. So investing through mutual fund will give you the advantage of diversification. Many beginners tend to focus on the stocks that have a market price of less than 100 or 50. That should never be a criteria for choosing a stock. Brokerage could eat your returns if you purchase small quantity of the stock. On the other hand, you would be able to gain access to the wide basket, that is number of stocks, for rupees 5,000 if you buy into a fund. Because what will happen, your investment will be spread over all those, that is the investments in which the mutual fund has made investment. Investing in the fund would also be an easy way to build your equity portfolio over the time. Let's say you can afford to put only rupees 1,000 a month in the market. Market means stock market. You can simply invest into a fund every month through SIP, systematic investment plan, as a matter of the financial discipline. You can save yourself of the trouble of scouting for a stock every month. So it means that say you don't have to take decision every month making a research that saying where you need to invest. That brings up the next point. Do you have the time to pick stocks? You need to invest a considerable amount of the time reading newspaper, magazines, annual reports, quarterly updates, industry reports, talking to people who are familiar with the industry practices. Else, you certainly won't catch a trend or pick up a stock ahead of the market. Means when the prices are low, you should buy. Prices are high, when that is at that point of time, you should sell. But for that say, you need to track all these things. So initially, as what we have discussed, there are two things which are required for generating return. One is skill, and second is that so you should be having proper time to make investments. How many great investors have you heard of who have not made investing their full-time job? Plus, you may have the time, but you do not have inclination. You have to be an active investor, which means continuously monitor the stock. You could pick and make the changes. Buy more, cut exposure, depending upon the turn on events. Means depending upon the macroeconomic changes, depending upon so the changes within the company, so you should constantly make a point that say you switch over the stocks. These actions have cost as well. As you churn your portfolio, means you reshuffle your portfolio. You bear expenses such as capital gain tax, that is say for short term you have to pay tax, for long term also now. Funds do not pay capital gain tax when they sell stock. All this assumes you know about you are doing and have skill to pick up the right stock. You are likely to be better at investing in industry you understand. Only too bad if that's the industry appears to be out of favor of the market. If you love the thrill of ups and downs in the stock market, you could find yourself turning into the business channels and business newspapers hoping that you can pick the next Infosys. If you have an instinct for spotting the stocks and importantly discipline on that is to act on it. If you have emotional maturity to cut your losses when you are ahead, then you can trust yourself say to invest in the stock. It means that say when the prices are falling down and you have an instinct that say it will definitely further fall down, then you should square off the position say with the loss that you have. I purchased a stock at the rate of 1,000. The prices are going down to that is 900, because when I purchased I was expecting the price to go up, but unfortunately the prices are going down. Then in that case you should be having that say the decision power to sell at 900 and freeze your loss 100. If at all you wait further, then in that case the loss may increase. Otherwise, hand over your money to the professional. Mutual funds could be the best avenue for risk averse investor. Risk averse means those who want to take less risk. Evaluation of the Indian mutual fund industry. The mutual fund industry in India started in 1963 with the formation of UTI, Unit Trust of India, at the initiative of Government of India and the Reserve Bank of India. So they were the main corpus of the fund. The history of the mutual funds in India can be broadly divided into four distinct phases: 1964 to 1987, 87 to 93, 93 to 2003, and say 2003 to 2014, and say from May 2014 onwards. UTI was established in 1963 by an Act of Parliament. It was set up by the Reserve Bank of India and functioned under the regulatory and administrative control of Reserve Bank of India. In 1978, UTI was delinked from the Reserve Bank of India, and IDBI, Industrial Development Bank of India, took over the regulatory and administrative control in place of Reserve Bank of India. The first scheme launched by the UTI was UTI Scheme 1964. At the end of 1988, UTI had rupees 6,700 crores of asset under management, that is AUM, asset under management. From 1987 to 1993, entry of the public sector funds. 1987 marked the entry of non-UTI public sector mutual funds set up by the public sector banks. LIC, GIC, State Bank of India Mutual Fund was the first non-UTI mutual fund established in June 1987, followed by Canback Mutual Fund in December 87, Punjab National Bank August 1989, Bank of India, Indian Bank, Bank of Baroda. LIC established its mutual fund in June 1989, while GIC had set up its mutual fund in December 1990. At the end of 1993, the mutual fund industry had AUM of 47,004 crores. So from 6,700, it increased to 47,004 crores. Third phase, with the entry of the private sectors in 1993, that is, so the government of Mr. P.V. Narasimha Rao, and the finance minister was Dr. Manmohan Singh. A new era started in Indian mutual fund industry, giving Indian investor a wider choices of the fund families. Also, 1993 was the year in which the first mutual fund regulation came into being, under which all mutual funds except UTI were to be registered and governed. The erstwhile Kothari pioneers, now merged with the Franklin Templeton, was the first private sector mutual fund registered in July 1993. The 1993 semi-mutual fund were substituted by more comprehensive and revised mutual fund regulation in 1996. The industry now functions under semi-mutual fund regulations 1996. The number of mutual fund houses went on increasing, with many foreign funds setting up funds in India. The industry also witnessed several mergers, acquisitions. At the end of the January 2030, that is 2003, there were 33 mutual funds with total asset of 1,21,805 crore. The UTI in India, so UTI with 44,541 crores of AUM was way ahead of the other mutual fund. Then from 2003 to 2014, in February 2003, following a repeal of UTI Act of 1963, UTI was bifurcated into two separate entities. One is the specified undertaking of the UTI with asset under management of 29,835 crore at the end of the January 2003, representing broadly a set of US 64 scheme that was initially started, assured returns and say certain other schemes. The specified undertaking of the UTI functioning under administrator and control of the, that is a control administrator and under the rules framed by the government of India, does not come under the purview of the mutual fund regulations. The second was the UTI Mutual Fund sponsored by SBI, PNB, BOB and LIC. It is registered with the SEBI and functions under mutual fund regulations. With the bifurcation of the erstwhile UTI had in March 2000 more than 76,000 crores of the AUM, and with the setting up of the UTI Mutual Fund conferring with SEBI Mutual Fund, with the recent mergers taking place over different private sector funds, the mutual fund industry has entered its current phase of the consolidation and growth. Because with the different mutual funds, so the expense will also be more, and with the merger they will be able to have so the advantage of the synergy. Moreover, its efforts to increase the investor awareness, the industry and the SEBI have launched several initiatives. This includes literature and campaign to propagate financial education to various investor segments, including potential investors, such as school, college students, homemakers, executives, and so on. Mutual fund industry also could not save itself from the financial turmoil of 2009 as securities market tanked. We know that so that was the time period in which in United States of America there were number of the you must have heard about the case of the Lehman Brothers. So that was the time when the stock market had sunk. In addition to the absolute entry load by the SEBI, also worsened situation of the mutual fund who was already struggling to maintain its economic viability from 2010 to 2013. So the entry load is a kind of transaction cost which was levied by SEBI. Now, since 2014, to re-energize the Indian mutual fund industry and increases the penetration, SEBI introduces several measures. With the formation of the new government and success measures taken in reversion of the negative trend, situations improved significantly. Hence, since May 2014, the industry has witnessed steady inflow and increase in the number of investors as well as asset under management. In a way that since it is like the Modi ji government the things have changed. Mutual fund distributions connected themselves to small town and also enable the investors to invest in appropriate scheme and retain investors during the course of the volatility and experiencing them benefit of investing in the mutual fund. With hand-holding of the investors and the mutual fund distributors who convince them to stay invested and encouraging them to invest in the mutual fund when the net asset value in the financial year 2015-16 witnessed steady positive net inflow through though the same year was not good for the Indian securities market. Now this is important. Classification of the mutual fund. There are three different types of the classification of the mutual fund: functional, portfolio and ownership. The functional classifications funds are divided into open-ended and closed-ended. Open-ended means regular sale purchase is taking place, and closed-ended means so the investors investment will be locked for a specific time period. and if at all the investors want to redeem the investment, then in that case he is required to rely on the secondary market. In an open-ended scheme, the investors can make entry and exit at any time. That is what are the kind of examples that we have seen normally. Also, the capital of the fund is unlimited and the redemption period is indefinite. On the contrary, in a closed-ended scheme, so there is a specific time period, the investors can buy into schemes during IPO or from the stock market after the units have been listed. The scheme has a limited life at the end of which the corpus is liquidated. Means whatever the net asset value at that point of time, so will be proportionally distributed to all investors. Till that point of time, so there is nothing to be paid to the investor. The investor can make his exit from the scheme by selling the stock in the market, means units in the market, or at the expiry of the scheme, or during repurchase period at his option. So there may be some repurchase scheme which is say provided by the mutual fund in between. Then in that case, say you may exercise it. And of course, friends, it will be at the current NAV. Interval schemes are a cross between open-ended scheme and closed-ended structure. These schemes are open for both purchase and the redemption during a pre-specified intervals. Example, that is namely monthly, quarterly, annually, etc. at the prevailing NAV based prices. So once in 6 months, say the scheme will be open like that, or once in 3 months it will be open like that. Interval funds are very similar to closed-ended funds, but differ on the following points. They are not required to be listed on the stock exchanges, as they have inbuilt redemption window. They can make fresh issue of the units during the specified interval period at the prevailing NAV based prices. Maturity period is not defined. The next is the portfolio. Funds are classified into equity fund, debt fund, and special fund. Equity fund invests primarily in stock. A share of the stock represents a unit of the ownership in a company. If a company is successful, shareholders can profit in two ways. The stock may increase in the value, or the company can pass on its profit to the shareholders in form of dividend. If the company fails, a shareholder can lose the entire value of his or her shares. However, a shareholder is not liable for the debts of the company because of the limited liability. Equity funds, debt funds, special funds, now these things are very important from examination point of view as far as the theory questions are concerned. The equity funds are of the following types: growth funds, aggressive funds, income funds. They seek to provide long-term capital appreciation to the investor and are best in long-term, that is best to the long-term investor. They look for the supernormal returns for which the investment is made in startup, initial public offers, and speculative shares. They are best to the investors willing to take risk. That is, usually it is the small cap funds in which the investments can be made aggressive. Income, they seek to maximize the present income of the investor by investing in the safe stock, paying high cash dividend, and high yield to money market instruments. They are best to the investor seeking the current income. Debt funds, that is the debentures that comes in our mind first. Debt funds are of two types. One is bond fund and the second is gilt funds. Okay. They invest in fixed income securities. Example, government bond, corporate debenture, convertible debenture, money market. Investors seeking tax-free income go in for the government bond, while those looking for the safe, steady income buy government bonds or high-grade corporate bonds. Although there have been past exceptions, bond funds tend to be less volatile. So of course, any investments which is other than equity like this will have the less volatility, because the volatility of the NAV depends upon the volatility of the investment that you have made. If at all you have made investment in the small cap fund, then in that case it will have the maximum volatility. Large cap will have the least volatility in case of the equity instruments. And of course, when you make investment in the debt, then in that case again it will be having the least volatility. Then stock funds, and often produces regular income. So these kind of investments will not give you the capital appreciation. Whenever you make investment in the debt funds, it will give you the regular less income. It will not give you the high income. Further, many a times practically it does not even cover the inflation. That is what's the kind of the huge risk that you have. For these reasons, investors often use the bond fund to diversify, provide a stream of the dividend, or invest for intermediate term goals. However, like stock funds, bond funds also have the following risk and can lose money. So what are the risks which bond funds have? That is what they have provided over here. The first is the interest rate risk, second is the credit risk, third is the prepayment risk. So these are the three risks that we have. The risk is similar to the risk of the default in payment of the loan or payment of the interest, or both, by the borrowers of the funds. Friends, there are number of practical examples wherein when an investor is making investment in this kind of the debentures or bonds and the company has defaulted. So there are number of such examples. So the investors are having the huge loss, because when I make investment in the debenture, then suppose I'm an informed investor, then I'm ready to share. That is I'm prepared for the lower return, but I want my principal to be secured. But unfortunately, even my principal is lost. Thus, risk takes place when a mutual fund which invested in money in the bonds of the company defaulted in the payment of the interest or principal. The risk is higher in case of the companies with low credit rating. And further, friends, when you make investment through mutual fund, of course, the mutual fund is going to make investment in 100 companies. So all those companies will not default. So you will not be having a huge risk, okay, because you have invested through mutual fund. But we understand that, say, from the investor point of view, they are having the loss of the entire principal if at all directly I have made investment, say, in that fund. The risk is related to the early refund of the money by the issuer of the bond. So basically we are discussing right now the kind of risk that the mutual fund is having when they are making investment in such kind of bond, when they are making investment in such kind of securities, because ultimately whatever the risk that the mutual fund will have, in turn investor will also have before the date of maturity. Dear students, we have a segment to learn in our security valuation, security analysis chapter, wherein we are going to understand a concept which is given a name as the callable bonds. I just give you a small explanation of the same. What happens at say, let us say that there is a company called ABC Limited which has issued debentures of rupees 300 lakhs for a time period of 20 years, offering the rate of interest of 12%. However, after 5 years, the rate of interest has gone down in the market, and the new rate of interest is, let us say, 10%, in a way that say any company can float the security by offering the interest at the rate of 10%. Now, this company was aware that it may happen that the rate of interest will fall down in the market. So what this company might have done, it might have issued the debentures with callable feature. So when that callable feature has been say added by them, then in that case it gives a right to ABC Limited that it can redeem the debentures at any point of time. So what ABC Limited will do at the end of the 5 years, it will redeem the investment. So what happens at say the investor is required to make the reinvestment of the funds say at the rate of interest of 10% instead of 12% at which the investor was getting the return. Of course, say in case of the early redemption, usually some amount of the premium is given to the investor. So this is the prepayment risk, and of course it arises when the rate of interest is falling down in the market. So you have a risk that say the amount that you have received is required to be reinvested at a lower rate. This is generally happens in case of the falling interest rates. When a company who already issued the bond at high interest rate issues fresh bond at a lower rate of interest, exercising its right to for early redemption of the callable bonds. This is covered in our chapter of security analysis, security valuation, and refunding the money raised out of fresh issue. Gilt funds, that is the second type of funds. They are mainly invested in government securities. Special funds are of four types. So the next is what they have provided is a special funds, after debt funds. Special funds are of four types. One is index funds, second is international funds, offshore funds, sector funds, money market funds. Fund of funds, capital protection oriented funds, gold funds, index funds. Dear students, the term index is what we already have understood in our chapter of derivative, wherein we understand that the Sensex is an index, Nifty is an index. So the funds which are making investment as per that indices is what we understand is the index funds. Every stock market all over the world has stock index which measures the upward and downward sentiment of the stock market. Index funds are low cost funds and influence the stock market. Why it is low cost funds? Because the fund manager does not have to apply his mind. He just have to follow those stocks proportion. And with that say he is required to just maintain say the proportion of the fund as per the indices. That's it. The investor will receive whatever the market delivers. So if at all I have made investment say in an index which tracks Sensex, then we understand that say whatever the return of the Sensex itself is a return that say I will be able to get. International funds, A mutual fund located in India to raise money in India for investment globally. And this is definitely practically possible. Let's say you can make investment in a mutual fund, say which is making investment in outside India. Maybe you are investing in Apple, you are investing in Google, like that. A mutual fund located in India to raise money globally for investing in India, that is offshore funds. They invest their entire fund in a particular industry. Example, utility, for utility in, that is industrial industries like power, gas, public works, or we understand that say something like called you are making investment in banking sector, in pharma sector, in PSU, in this way. Money market funds, these are predominantly debt oriented scheme whose main objective is the preservation of the capital. See, this is important. Preservation of the capital, easy liquidity, and moderate income. Honestly, it is very less income. To achieve this objective, liquid funds invest predominantly in a safer short-term investments like commercial paper. So safety is the most important thing. Certificate of deposit scheme, simple fixed deposit. Treasury bill issued by central government. G6, that is a government security, and etc. These schemes are issued mainly by the institutions and individuals to park their surplus funds for short period of time. These funds are more or less uh, insulated from the changes in the interest rate in economy and capture the current yield prevailing in the market. Fund of funds. Fund of fund, as the name suggests, are the schemes which invest in other mutual fund schemes. The concept is popular in the markets where there are number of mutual fund offering, and choosing a suitable scheme according to one's objective is tough. Just as a mutual fund scheme invests in a portfolio of securities such as equity, debt, etc. The underlying investments for fund of fund is the units of other mutual fund schemes, either from the same fund family or from the other fund houses. Capital protection oriented fund. The fund capital protection oriented scheme means a mutual fund scheme which is designed as such and which endeavors, that is which makes an effort to protect the capital invested therein through suitable orientation of its portfolio structure. The orientation towards protection of the capital originates from the portfolio structure of the scheme and not from any bank guarantee. So we have the structure in such a way, insurance cover, etc. SEBI stipulates require these types of the schemes to be close-ended in nature, listed on the stock exchange, and intended portfolio structure would have to be mandatorily rated by a credit rating agency. So you give an assurance, say for the capital protection. So these are the conditions in which you are required to meet. A typical portfolio structure could be set aside a major portion of the asset for capital safety and could be invested in highly rated debt instruments. The remaining portion would be invested in equity or equity related instruments to provide capital appreciation. So of course, if at all I have to give an assurance to you that say your capital is going to remain intact, then I cannot make investment of that funds say in highly volatile market. So major portion will be invested in such a way where there is always a security of the capital and the remaining amount will be invested in equity. Capital protection oriented schemes are recent entrant in the Indian capital market and should not be confused with the capital guaranteed scheme. Gold funds. The objective of these funds is to track the performance of the gold. The units represents the value of the gold or gold related instruments held in the scheme. Gold funds, which are generally in form of exchange traded funds ETF, are listed on the stock exchange and offers investors an opportunity to participate in the bullion market without having to take the physical delivery of the gold. We always know that the gold is say an investment which the investor is say number of times looking for so as to have a kind of security, but so there is always a practical difficulty of say the storing of the gold, and we know that so there is always a threat that we have of the theft or something like that. That is the reason say these kind of say the schemes are best in that way, wherein we understand that say there is only a certificate which is in your demat account and your performance of your like investment is as per the gold prices. Gold prices are increasing, then units of this mutual fund will also increase and vice versa. So risk and reward for the type of funds. Generally the risk and reward go hand in hand, means say both of them are say going in the say the same direction. Low risk and return, money market funds, short term intermediate term bond funds, long term bond funds, balance funds. So the balance funds is so the mixture of both of them, equity and debt both. Growth and income stock funds, only growth and aggressive growth. So aggressive growth stands for, we understand that's the small cap funds. This is small cap funds that we have. Small, mid and say the large. Large will have the low, that is say the lowest risk. And we have say diversified also, wherein say they have determined that say you should not be having say more than a certain percentage say in large cap, more than a certain percentage in mid cap, and more than a certain percentage in small cap. Ownership classification. Funds are classified into public sector mutual fund, private sector mutual fund, and foreign mutual fund. Public sector mutual funds are sponsored by a company of the public sector. Private sector mutual fund is sponsored by a company of the private sector. Foreign mutual funds are sponsored by the companies for raising funds in India, operate from India, and invest in India. Direct plan in mutual funds. AMC, asset management companies, have been permitted to make direct investment in mutual fund schemes even before say 2011. But there were no separate plans for these investments. These investments were made in distributor plan itself and were tracked with a single NAV, one of the distributor plans. Therefore, an investor was forced to buy mutual fund based on NAV of the distributor plans. However, the things have changed with the introduction of the direct plan by SEBI from 1st of January 2013. The mutual fund direct plans are those plans where asset management companies or mutual fund houses do not charge distributor expenses, trail fees, and transaction charges. NAV of the direct plan are generally higher in comparison to a regular plan. Studies have shown that the direct plans have performed better than the regular plans for almost all the mutual fund schemes. That is the direct plan in the mutual fund. Next is types of schemes. So one is the balance funds. Second is the equity diversified funds. Then equity linked saving schemes, sector funds, thematic funds, arbitrage funds, hedge funds, cash fund, ETF exchange traded funds, fixed maturity plan. So these are the plans that we have. So friends, from examination point of view, there is a possibility that say you'll be provided with one of the scheme to be explained, because generally the questions of the theory have maximum 4 marks weightage. Sometimes it is 5, but that is usually 4. It may be 3. So in that case, they will be asking only one of the schemes. So you don't have to remember name of all of them. You just have to understand and say what is there in the individual scheme from examination point of view. Balanced funds make strategic allocation to both debt as well as equity. It mainly works on the premise that while it is the debt portfolio of the scheme provides stability, the equity one provides the growth. It can be in an ideal proportion for those who do not like total exposure to equity, but only substantial exposure. Such fund provides moderate return to the investors, as the investors are neither taking too much risk or not too low risk. So you are having investment in both. Equity diversified. So from your examination point of view, you may write something like this: equity plus debt. We understand that so the more proportion of the equity, risk is more, and that is so the chances of return is also more. Less proportion of equity, return is less, and the risk is also less. A diversified fund is a fund that contains wide array of the stocks. The fund manager of a diversified fund ensures a high level of the diversification in its holding, thereby reducing the amount of the risk in the fund. So diversification in the holding. In that, so they have provided flexi-cap, multi-cap funds. So all the 3 kinds of funds: contra funds, index funds, dividend yield fund. These are by the definition diversified funds. The only difference, that is, unlike a normal diversified fund, the offer document of the multi-cap or flexi-cap fund generally spells out the limit for minimum and maximum exposure to each of the market cap: large cap, mid cap, small cap. Large cap is first 100 companies, mid cap is next 150, and the small cap is, say, the remaining. A contra fund invests in those out of favor companies that have unrecognized value. It is ideally suited for investors who want to invest in a fund that has the potential to perform in all type of the market environment, as it blends together both growth and value for the opportunities. Investors who invest in contra funds have an aggressive risk appetite. So this is what, say, we are making investment in certain securities wherein there is a huge risk. So there is a possibility that you will be having a huge return, and there is a possibility that your entire money will be lost. Index funds, that is Sensex. Okay. So you may write something like this over here, that is, say, unknown companies. Then you may write over here, that is large plus small plus mid. And the important point over here is the minimum and maximum exposure. That is, we can say that, say, the range will be 20 to 30, then 30 to 50. That is the way that they have provided range. So if at all, what happens that, say, I take money from you saying multi-cap, and I make investment of 80% of the funds in large cap only, then in that case that does not make a sense. Only for the name, that is, I say it is the multi-cap. So in multi-cap, any one of the, that is the capitalization companies should not be more than 50, something like that. Only in that case it is truly that you have diversified the portfolio. You should not be having say any of the like the capitalization securities which whose proportion is less than 25. That is the way that I will be having a diversification. An index fund seeks to track the performance of a benchmark in the market index like BSE Sensex or Standard and Poor CNX Nifty. Simply put, the fund maintains a portfolio of all securities in the same proportion as stand in the benchmark index and earns the same return as earned by the market. So when Sensex is going up, then I know that say my portfolio is also going to have the increase in the return. Why? Because say I have made investment in the index fund. When Sensex is going down, then I am prepared that say it will be having such a lower return. And friends, importantly, what happens at say the fund management charges will be very less comparatively over here because you don't have to apply your mind. So the experts are not required over here. Dividend yield fund. A dividend yield fund invests in the shares of the companies having high dividend yield. Dividend yield is defined as dividend per share divided by the shares market price. Most of the funds invest in the stock of the companies having high dividend yield higher than the dividend yield of the particular index, that is Sensex or Nifty. The prices of the dividend yield stocks are generally less volatile than the growth stocks. Besides, they also offer the potential to appreciate. Among the diversified equity funds, diversified means in all kind of market capitalization you have made investment. Dividend yield funds are considered to be medium risk proposition. However, it is important to note that dividend yield funds have not always proved resilient in short-term corrective phases. Dividend yield schemes are of two types: dividend payout option and dividend reinvestment option. Dividends are paid out to the unit holders under this option. However, the NAV of the units falls to the extent of the dividend paid out and applicable statutory levies. In a way that we understand that say when the dividend is paid, the market price of the equity share reduces. Similarly, the NAV per unit is also falling down. The dividend that accrues on the units under the option is reinvested back into the scheme at X dividend NAV. And we have done number of questions like this. Hence, the investors receive additional units on their investment in lieu of the dividend. Next is the equity linked savings scheme. ELSS is one of the options for the investors to save tax under section 80C of the Income Tax Act. They also offer the perfect way to participate in the growth of the capital market, having a lock-in period of 3 years. In addition to that, ELSS has the potential to give better returns than any traditional tax savings instrument. Traditional tax saving instruments we know is like the National Savings Certificate, or we know that say like certain investments like PPF, those are not going to give you the prominent returns. In comparison to that, you study in your office also, that is you do this kind of work also. ELSS scheme for tax benefit one, that is tax savings advantage. Moreover, by investing in ELSS through SIP, one cannot avoid the problem of investing a lump sum towards end of the year, but also take the advantage of averaging. The term averaging stands for like this. What happens at the units value may be fluctuating. However, you are making investment of the same amount every time. So When the NAV is high and you make investment, you'll be getting lower number of units. But when NAV is low and you make investment of the same amount, you'll get the higher number of units. So you will be having the purchase on average value. Sector funds, so it is pharma sector, then FMCG sector, then banking sector. Like that, say you make investment in a specific sector because you believe that that sector is going to have good performance in the time to come. These funds are highly focused on a particular industry. The basic objective is to enable the investor to take advantage of that industry cycles. Since the sector funds ride on market cycles, so we understand logically that say when you are making investment in a sector type funds, so what happens that say all the companies belonging to that sector is selected. That is all the companies who belong to the banking sector or all the companies who belong into the pharma sector are selected. They have the potential to offer good returns if the timing is perfect. However, they are benefit of down risk protection as available in the diversified funds. So you don't have the advantage of the diversification if you make investment only in one sector. So in that case, the risk increases comparatively. When you make investment in diversified, you'll have this kind of volatility. When you make investment in a sector, then in that case, when you make investment in a specific sector, this is the volatility. And when you make investment in a diversified, you'll have less volatility. So specific sector, and this is diversification. Sector funds should constitute only a limited portion of one's portfolio. So ideally you should not be having say the major amount of the investment say in a specific sector portfolio, as they are much riskier than a diversified fund. Besides, only those who have an existing portfolio should consider investing in these funds. So you should not be having your sole investment to be made in a sector fund. For example, real estate mutual funds invest in real estate properties and earn income in form of rental, capital appreciation from developed properties. Also, some part of the fund corpus is invested in equity shares or debentures of the companies engaged in real estate asset or developing real estate development projects. So you can very well understand that say if at all there is say downfall in the real estate, then your entire portfolio will have the very bad performance. Real estate mutual funds are required to be close-ended in nature and listed on the stock exchange. Thematic funds means say there is a specific theme and on that so the mutual fund is making investment. A thematic fund focuses on the trend that are likely to result in outperformance by certain sectors or companies. The theme could be vary from multi-sector, international exposure, commodity exposure, etc. Unlike a sector fund, theme funds have broader outlook. However, a downside is that the market may take longer time to recognize views of the fund house with regard to a particular theme, which forms the basis of the launching of the fund. Arbitrage funds, that is again very less risky. Typically, these funds promises safety of the deposits, but better returns, tax benefit, and a greater liquidity. ICICI is the latest to join the list, its equities and derivative funds. The open-ended equity scheme aims to generate low volatility returns by investing in the mix of the cash equities, equity derivative, and debt market. The fund seeks to provide better returns than the typical debt instrument and lower volatility in comparison to the equity. This fund is aimed at investors who seek the return of the small saving instruments, safety of the bank deposit, tax benefit of the Reserve Bank of India relief, and liquidity of the mutual fund. Arbitrage fund finally seeks to capitalize on the price differential between the spot and the future market. The other schemes in the arbitrage universe are benchmark derivative, JM equity and derivatives, prudential ICICI balance, UTI spread, and prudential ICICI equity and derivatives. That is the arbitrage funds. Hedge funds, as the name is there, hedge funds means we understand that so the hedging is again what you have studied in the derivative. Based on that, say we are having such a fund. A hedge fund is likely regulated investment fund that escape most regulation by being a sort of the private investment vehicle being offered to the selected client. The big difference between a hedge fund and a mutual fund is that the former does not reveal anything about its operation publicly and charges a performance fees. Means if at all there is a performance, only in that case you have to pay, not otherwise. Typically, if it outperforms a benchmark, it takes a cut of profits. Means let us say that so the 10% is a return, which is the cutoff. So actual return is 15%. Then only from that 5% you are required to give the fees. Of course, this is one of the way of street. Any losses are borne by the investor themselves. Return is less than 10%, you don't have to pay anything. There is a loss, you don't have to pay loss. In a way that you have to bear the loss and you don't have to pay the fees. Hedge funds are aggressively managed portfolio of the investment which uses advanced investment strategies such as levered, long, short derivative positions. You are expecting that so the Nifty will go up, so you take a long position Nifty. You are expecting that so the Nifty is going to go down, you take a short position in Nifty. Levered stands for you borrow and invest. Leverage is a word that you have studied at your IPC or intermediate level, wherein you borrow and you invest. So in that case, obviously the risk will be much more. In both domestic and international market, with the goal of generating high returns, either in absolute sense or over a specific market benchmark. So you may be having such a benchmark also that is with which it is supposed to be compared.